Good morning everyone, and welcome. Today, we will be exploring the critical topic of financial statements and their impact on capital markets. Our focus will be on the integrity of these statements, the risks of fraud, and how prevention measures are implemented. We'll also delve into the historical trends of financial statement fraud and examine the regulatory responses designed to maintain market stability. This is an important area that affects investors, companies, and the broader economy, so I'm looking forward to sharing insights and discussing how we can work towards a more transparent and trustworthy financial environment. Financial statements are absolutely fundamental in capital markets because they act as the primary source of financial information for investors and other market participants. They give us a comprehensive view of a company's overall financial health, its performance over time, and its risk profile. This detailed insight is crucial because it allows investors to make well-informed decisions about where to put their money. When financial reporting is accurate and timely, investors can evaluate potential opportunities with much greater confidence. Moreover, these statements support the efficient allocation of capital, ensuring that funds flow to the most promising and productive areas of the market. Finally, reliable financial statements are essential for maintaining transparency in the markets. Without them, the openness and fairness that keep capital markets vibrant and trustworthy would be severely compromised. Financial statement fraud seriously undermines the integrity of financial reporting by intentionally distorting a company's true financial condition. This misrepresentation can hide real operational problems or exaggerate financial strength, leading investors to make decisions based on inaccurate information. As a result, investor trust diminishes, causing reduced liquidity and increased volatility in capital markets. When confidence is lost on a larger scale, it can destabilize entire national economies by creating systemic risks, discouraging investment, and driving up the cost of capital. Ultimately, this kind of fraud misleads investors, damages markets, and poses a significant threat to overall economic stability. Let's take a closer look at financial statement fraud over the 20-year period from 1987 to 2007. Our analysis begins in 1987, marking the starting point when data collection revealed some important trends in fraudulent reporting. Throughout these 2 decades, we see clear cycles where fraud spikes, often coinciding with times of economic stress and increased market pressures. During this time, several high-profile corporate scandals captured widespread public attention, shining a spotlight on unethical practices within major companies. These incidents didn't just impact the companies involved, they also prompted significant changes in regulations and led to heightened investor scrutiny, aiming to prevent future occurrences. Despite these efforts, fraud tactics continued to evolve, becoming more sophisticated in concealing misstatements, which underscores the ongoing challenges regulators and market participants face in maintaining market integrity. When we look at why financial statement fraud persisted from 1987 to 2007, several important factors come into play. First, economic downturns played a big role. During tough times, there was a strong incentive to manipulate numbers in order to present a rosier picture than reality. On top of that, intense market competition and constant pressure to meet or exceed earnings expectations pushed some to cross ethical lines. Another critical factor was weak corporate governance. When internal controls are lacking or ineffective, it creates the perfect environment for fraud to take hold and continue undetected. All these elements combined created risk factors that fraudsters were quick to exploit, leading to a cycle of ongoing fraudulent activities. Understanding these drivers is key to preventing such issues in the future. As awareness of financial statement fraud grew, regulators responded by enacting a range of legislative measures focused on both preventing and detecting these fraudulent activities. One of the key steps was enhancing transparency. This meant imposing stricter reporting and disclosure standards, so companies are more open about their financial health. Another critical focus was on auditor independence and accountability, ensuring auditors remain impartial and responsible in their evaluations. To deter wrongdoing, these laws also introduced harsher penalties for those engaged in fraud. Ultimately, the goal of these regulations was to restore investor confidence by strengthening oversight and encouraging ethical behavior within corporations, addressing the key vulnerabilities in how financial information is reported. Detecting financial statement fraud requires a methodical and strategic approach. First, it's essential to ground our detection efforts in critical inquiry, which means questioning assumptions and looking beyond the surface. Next, we dive into internal management practices, scrutinizing how the company is run, its organizational setup, and operational habits to spot any inconsistencies or unusual patterns that might raise red flags. We also need to assess external relationships, paying close attention to transactions with related parties or any unexpected business alliances that could be suspicious. Then, we analyze the financial results themselves, especially if they stray from industry norms or don't follow past trends, as these deviations might signal underlying issues. Finally, by applying targeted reasoning and systematically questioning each of these areas, we can uncover potential indicators of fraud early on and ensure a thorough investigation. This framework helps maintain a sharp, focused approach to detecting fraud before it becomes a bigger problem. Preventing financial statement fraud requires us to stay continuously vigilant, supported by strong detection systems that can catch issues early. Protecting the accuracy and reliability of financial reporting is essential. Not only does it shield investors from potential harm, but it also upholds the integrity of capital markets around the world. This is not a task any one group can handle alone. It calls for a collaborative effort among regulators, auditors, investors, and company management, all working proactively to identify risks, enforce compliance, and encourage transparency. Ultimately, this teamwork aims to ensure the long-term stability and fairness of our financial markets, benefiting everyone involved.